This is a demonstration of exercise 841, return on equity and a large Treasury stock balance. N.J. Simpson, Inc. reported the following equity accounts in its 2019 balance sheet, and they give us stock prices for the past 3-year ends. So the problem has given us shareholders' equity for 2019, 2018, and 2017, the ending stock prices for those years, and the earnings attributable to the company's shareholders, and the consolidated net income. The problem asks us in Part A to compute return on equity for 2019 and 2018 under the following assumptions. So the first assumption is to compute return on equity using the traditional definition of equity. So we know return on equity is equal to net income divided by average equity. Now when we have non-controlling interest, which N.J. Simpson does, they have non-controlling interest, we have to use the equity that is attributable to the company's shareholders and the earnings that are attributable to the company's shareholders. So to compute return on equity, we're first going to take the net income and we're going to divide that by our average equity. So our beginning and our ending equity divided by 2. So that is our return on equity for 2019, and now we'll compute it for 2018. And we see that our return on equity for 2019 is 115.88%, and for 2018 is 21.32%. The second assumption is to add back Treasury stock to equity. So we're going to make the same calculation, except we are going to add back the Treasury stock in each of the years. So we'll add back for 2019 and for 2018. And we see now that our return on equity has decreased to 15.23% for 2019 and 12.59% for 2018. The third assumption is to use the market value of equity instead of the book value. So the first thing we need to compute is the market value of the equity for each of the years. Now, to determine that, we need to have the number of outstanding shares times the market price. So first we're going to determine what is the outstanding shares. The problem tells us that they issued 40,000 shares in each year. However, they have Treasury shares. Outstanding shares are the issued shares minus the shares that are held in Treasury. So we need to subtract each one of the Treasury shares for each of the years. So issued minus Treasury gives us outstanding. Then we need to multiply that by the market price for each of the 3 years. And the spreadsheet has calculated the market value of the equity for each of the 3 years. Now, to compute the return on equity, then, we take the net income attributable to the company's shareholders for each of the years, and we take the market value of equity, and we determine the average, and we divide the net income by the average market value of equity. And we see for 2019 the return on equity is 6.82%, and for 2018 is 5.39%. The B portion of the problem asks, which of these metrics do we believe best measures the company's return for the past 2 years? So we know when we look at the traditional return on equity that it is inflated greatly by these Treasury stock purchases that have reduced equity and inflated the return on equity. We notice in the return on equity with the market value that it is very low. The reason why is that the current market price is going to include future earnings. Remember that the shareholders are figuring into the market price the company's future earnings. The return on equity where we add back the Treasury shares is probably the most reliable. The reason why is we could resell those Treasury shares and get our cash back, and that would also increase stockholders' equity. So overall, the return on equity adding back the Treasury shares is probably the best for determining return on equity. And that is the conclusion of the demonstration for exercise 841.